Silver is everywhere right now. And if your feed looks anything like mine, you've probably seen the headlines screaming about record prices, limited supply, and massive upside potential. Silver has surged far beyond what most investors once thought was realistic. Prices that once sounded too optimistic are now reality. And suddenly everyone, from TikTok finance creators to Reddit traders, is talking about silver like it's the next big thing. And let's be honest, when prices move fast, FOMO kicks in. Especially if you're a millennial or Gen Z investor who watched gold explode and thought, I missed that run, I'm not missing this one. But here's the problem. When an asset is flying higher every week, our brains naturally lock on to the upside. We imagine protection from inflation, diversification away from stocks, and maybe even a hedge against economic chaos. What we don't imagine? The risks, the drawdowns, the moments when silver stops being shiny and starts testing your patience. Silver isn't just another metal. It behaves differently than stocks, differently than crypto, and even differently than gold. That unique behavior can work for you or against you, depending on timing and expectations. And right now, when prices are already elevated, that difference matters more than ever. Because chasing momentum without understanding the downsides is how investors get trapped, buying high and panic selling low. So before you click buy, before you stack coins or add another ETF to your portfolio, it's worth slowing down and asking a smarter question. What can actually go wrong with silver? In this series, we're breaking down the real downsides of investing in silver, especially in today's hype-driven market. Without fear-mongering, without hype, just facts. In the next part, we'll uncover why silver's price can move way more violently than you expect, and why that volatility hits younger investors the hardest. One of the biggest downsides of silver is something most new investors underestimate: volatility. Silver doesn't move gently, it swings, hard, fast, and often without warning. Compared to gold, silver is far more sensitive to market emotion. When hype builds, silver can spike aggressively, but when fear enters the picture, it doesn't just pull back, it drops sharply. This matters, especially for millennials and Gen Z investors who are used to fast-moving assets like crypto and meme stocks. The problem, silver looks stable because it's physical and historic, but it behaves emotionally like a risk asset. One week, silver is the inflation hedge of the decade. The next, it's down double digits, and nobody's talking about it anymore. Why does this happen? Because silver is a thin market compared to gold. Fewer buyers and sellers mean price changes get exaggerated. Small shifts in demand, or even headlines, can cause outsized moves. And unlike stocks, silver doesn't generate cash flow. There's no earnings report to stabilize expectations, no dividends to soften drawdowns. When prices fall, you're simply left watching red numbers, hoping for a bounce. This volatility can be especially brutal if you buy after a major run-up. Late entries often experience the sharpest pullbacks. That's when emotions take over and investors sell at the worst possible moment. So, if your risk tolerance isn't solid, silver can test you. Next, we'll break down why silver's heavy reliance on the economy can turn it from a hedge into a liability when growth slows. Here's something many silver investors don't fully realize. Silver isn't just a safe haven metal, it's also an industrial commodity. A large portion of silver demand comes from real-world uses: electronics, solar panels, medical tech, electric vehicles, and manufacturing. That sounds like a positive until the economy slows down. Because when economic growth weakens, factories produce less, construction slows, and industrial demand drops. And when that happens, silver can fall at the same time stocks are falling. That's a problem. Many investors buy silver expecting it to protect them during downturns, like gold often does. But silver doesn't always play that role. In recessions or near recessions, silver can behave more like a cyclical asset than a defensive one. We've seen this before. During economic shocks, silver often drops first, along with equities, before recovering later. That delay can be painful if you're relying on silver as a portfolio stabilizer. For younger investors building long-term portfolios, this creates a mismatch of expectations. You think you're diversifying risk, but in reality, you may be adding another asset that's tied to economic cycles. And because silver demand is split between investment and industry, it gets pulled in two opposite directions: inflation fear on one side, economic slowdown on the other. When growth wins that tug of war, silver prices can stall or decline even when inflation is still high. That contradiction catches many investors off guard. Coming up next, we'll expose the hidden costs of owning physical silver and why they quietly eat into long-term returns. Let's talk about the part of silver investing nobody puts in the highlight reel: the costs. If you're buying physical silver, coins, bars, or rounds, you're not just paying the spot price. You're paying premiums, sometimes high ones, especially during hype cycles. That means silver has to rise significantly just for you to break even. Then there's storage. Unlike stocks or ETFs, physical silver takes up space. You either store it at home, risking theft, or pay for secure storage, which quietly chips away at returns year after year. And selling? That's not always instant. Unlike tapping sell in a brokerage app, unloading physical silver can take time. You may need a dealer, you may accept a lower price, and in volatile markets, liquidity can dry up fast. Even silver ETFs aren't perfect. Some track futures, not physical metal. Others carry management fees, and none of them give you the psychological comfort many people expect when they hear the word precious metal. For younger investors who value flexibility and fast access to cash, these limitations can be frustrating. Silver demands patience and planning. If you don't factor in these frictions up front, the investment can feel far less attractive once reality sets in. In the final part, we'll pull everything together and explain when silver makes sense and when it's smarter to stay on the sidelines. So, does all of this mean silver is a bad investment? Not exactly, but it does mean silver isn't a set-it-and-forget-it asset. Silver can play a role in a diversified portfolio, but only when expectations are realistic. It's not a guaranteed inflation shield, it's not always a safe haven, and it's definitely not immune to sharp pullbacks. For millennials and Gen Z investors, the biggest risk isn't silver itself, it's buying into the hype without a plan. If you're using silver as a short-term momentum trade, volatility can work in your favor, if you're disciplined. If you're holding long-term, position sizing matters more than timing. Over-allocating to silver can quietly increase portfolio risk instead of reducing it. Silver works best as a supplement, not a centerpiece. A small allocation can provide diversification, exposure to industrial growth, and some protection against extreme inflation scenarios. But relying on silver alone, especially at elevated prices, can leave you disappointed. Smart investors don't chase headlines. They understand the asset, respect its limits, and position it accordingly. So before you invest, ask yourself, are you buying silver because it fits your strategy or because everyone else is talking about it? That answer makes all the difference. If you want to know how much silver actually makes sense in a modern portfolio, or whether alternatives like gold, tips, or commodities ETFs offer better risk-adjusted returns, make sure to check out the next video.